Hi everyone. A rally on Wall Street waned following the US inflation report. Stock figures fell sharply at the end of the week. The S&P 500 index and NASDAQ logged the worst weekly percentage drop since June. On Monday, they resumed their downward movement. Tech shares and other previously rising stocks suffered the biggest losses amid expectations of a 75 basis point rate hike on Wednesday. Investors fear that aggressive tightening could worsen the economic outlook and increase the unemployment rate against the backdrop of persistently high inflation. The main event of the week is the Federal Open Market Committee meeting. Some analysts expect a big rate hike by 100 basis points at once. However, investors remain cautious as other major central banks such as the Swiss National Bank and the Bank of England may also raise interest rates this week. If their monetary policies get more hawkish, it may store up market volatility. Speculators will also take notice of several earnings reports before the start of the next earnings season, which will begin in October. Watch our video till the end and find out more interesting details. Feel free to leave your comments down below. Let's start. Traders are now trying to accept their harsh reality. Their caution and uncertainty are justified. Not long ago, they believed that inflation in the United States has peaked. Therefore, they were actively buying risk assets. However, the latest report revealed that inflation would not slow down in the near future. The economy is losing steam. All the positive indicators may soon begin to deteriorate, reflecting the actual state of the economy. Besides, the yield curve has inverted even more. It's viewed as a sign of a looming recession. Inflation figures were disappointing but not daunting. Consumer prices declined slightly, although their reading was worse than expected. The core inflation, which may be a better gauge as it excludes food and energy prices, increased both in annual and monthly terms. Apparently, inflation is unlikely to ease in the near future. Investors will have to accept this fact as well as the Fed's strong commitment to rising key rates to return inflation to the 2% target. As it turned out, it was unwise to bet against the central bank, ignoring Fed officials' comments and hints. This was why we saw such a steep drop in the equity market. Wall Street notched its worst weekly performance since falling to the June lows. Stocks repeated a drastic decline that occurred in June. Earlier, investors assumed that the stock market bottomed out after reaching the June lows. Last week, the Dow Jones sank by 4.1%. On Monday, the index lost almost 300. The S&P 500 and NASDAQ tumbled by about 1% each. As a result, they ended the session with gains after a sharp weekly decline. Investors are now at the crossroads as stocks may either hold their decrease at the current levels or fall further. Since the indices have already reached their lowest levels, and positive statement or news may trigger an upward reversal. The question is whether we should expect good news. Now investors are largely focused on the Fed's meeting, so they are wary as there have been many hawkish signals. The September meeting may dramatically change the market sentiment, making it more bearish or bullish. Before the Fed meeting, traders have factored in hawkish rhetoric. Now they are anticipating more comments from the central bank on their future plans for monetary policy. The range of 3.5–3.75% has shifted higher to 4%. Market participants are curious about how quickly the regulator could push the interest rate to this range. At the moment, analysts forecast a key rate increase to 4% by December 2023. However, this level may also be too low for the Fed given the higher than expected CPI figures. According to the Fed funds futures, the likelihood that by April the interest rate will rise to 4.45% is extremely high. It's impossible to predict what to expect after that. Apart from key rates, at the September meeting, the Fed will provide new economic projections. They could determine the regulator's further steps on monetary policy till the end of 2022 and 2023. If the new projections turned out to be weak, the Fed will have to consider a softer stance. Yet it will be an extreme measure for the watchdog. The S&P 500 index fell by 4.7% over the week, dropping below the psychologically important level of 4,000. Analysts are trying to foresee how the index could break out of the downward channel. If the index slides below 3,900, it could reach the previous bullish gap of 3,795 and the June low of 3,630. However, the S&P 500 has already once broken through this level. If a bullish cross occurs at the 4,020 level, a short-term upward movement to the 4,115, 4,160 levels are likely. Some analysts see a correlation between the US dollar index, the VIX, and the S&P 500. It means that the key support level of 3,915 for the S&P will set the trend for the US currency. Whether this level will be broken or not depends on the trajectory of the US dollar before and after the FOMC meeting. Notably, the S&P has plunged by 18.2% this year due to concerns about the Fed's hawkish policy and the recent downbeat earnings report from the FedEx Corp. Apart from that, the inverted yield curve of the US Treasuries and warnings from the World Bank and the IMF about the impending slowdown in the global economy have also pushed the index down. Goldman Sachs slashed its forecast for US GDP in 2023 as it projects a more aggressive tightening through the rest of this year and sees that pushing the jobless rate higher than it previously projected. The heavy tech NASDAQ has slipped by more than 5% in a week. Currently, there are no positive fundamental drivers. As traders remain alert ahead the FOMC meeting, only 9.58 million shares were traded on the US exchanges on Monday. This is the sixth lightest day for the trading volume this year. Besides, there are many downside forecasts. If we draw a parallel with 2008, the S&P and NASDAQ may incur the biggest losses in the period from now until October 25. Time will show whether this assumption is accurate. If we take into account the US seasonal statistics prior to the election race, stocks may be able to rebound in the near future. The race for the president is not far off, and policymakers need to come up with certain strategies. An increase in stocks may be triggered by the Democrats. According to the statistics, more than 50% of U.S. households actively invest in the stock market. Household confidence may help Democrats in the upcoming elections. However, these are just predictions. The main driver for stocks will be the Fed's meeting. Zoom shares are a good example of stocks making new lows on the NASDAQ. The company's stocks has recently become a gauge of the prevailing trend in the market. Friday's drop in Zoom shares was hardly surprising. Its stock is likely to decrease lower. The next support level is located at $76.45 and the next one is seen at 70. That's all for now. Subscribe to our channel and stay up to date with the latest market news. See you!